right, welcome to chapter 15, investments. So in chapters 13 and 14, we talked about equity, stocks, and things like that to raise capital. We also talked about in chapter 14 about how we issue debt to raise capital as well, the pros and cons of both of those. Now we're going to looking at these things on the flip side. We're going to be looking at investments in those same types of vehicles, the equity or the debt. And as such, we're looking at it from the standpoint of us purchasing those types of vehicles as a way to earn some kind of return. So that's where we're going to be going forward with this. So let's go ahead and look at our learning objectives. There they are. Okay, I don't go through these individually just because we will go through them, so you can learn about them as we go. But you're welcome to pause the video, look at those if that's something that you want to do. Okay, so let's go ahead and look at this. So why do we invest? So remember, if we have a current ratio or even an acid test ratio that is very high. Let's say we're at a 4 or 5 point, 4.0, 5.0. We have a lot of current assets, and a lot of those is going to take the place of some form of currency, cash or cash equivalents. So if we have a lot of extra cash and we don't have any specific goal for it at this moment, we can use that to invest in other companies or just other vehicles to get a return. So we're not just having this cash sit in our bank account earning no return or very little return. We want to make sure that we get some money back from it. So we go there. Other companies need the money. We have the money. We want some money. Let's go ahead and just invest it. Uh, we this is just a little snippet of showing you how some companies have more short term versus long term. It really depends on the strategy, okay? And this is as a percentage of, I guess, of total assets. Does it? Yeah, okay. So you see Microsoft has 52% of their total assets invested in short term investments. That's interesting. Okay. Coca-Cola only has 8%, whereas Alphabet is 46%. Honestly, I don't even know who Alphabet is. I think I did at one point, but I don't remember who they are. Bottom line is, though, is you see that there's a good, you look at Alphabet and you look at Microsoft. Why do they have, see, these are the questions you should ask when you're analyzing a company. Why do they have so much of their investments in short term as opposed to Coca-Cola, who has more in long term as opposed to short term? The reason for it is a lot of times is when they need the cash, when they need the money back. Microsoft and Alphabet may need their money back sooner, or they've held long-term assets so long that now they're all coming due, and so there's a lot of short-term. You'd want to look at that over a period of time. But the point is that Microsoft and Alphabet probably need money sooner than later, whereas Coca-Cola's, hey, they're pretty good with where they're at. There's no major threat to have a new um, bottling company come out to compete against them. They're kind of established. It's a really hard market to get into. So they could put their money into long-term stuff because they really don't have anything that's coming due or needing to have to use their money for. Sorry, I'm kind of stumbling over things today. I've been sneezing today too, so if I sneeze too much in this, I apologize. So anyway, so that's kind of what we're looking at here, all right? So companies with those different terms. Short-term investments is basically anything that you can convert to cash within a year. They're already readily converted to cash, and they should mature somewhere between 3 to 12 months. They can mature in 1 month. I don't know why they say 3 to 12. I guess that's the usual thing, and perhaps they're looking at it from the standpoint of when you purchase it, that would mature between 3 to 12 months. If that's what they're trying to say, then yes, that's the case. But they can mature anywhere from between 0 months to 12 months, and those are the short-term investments we're looking at. Long-term investments are basically the opposite of short-term investments. They're not readily converted to cash, something beyond 12 months, and we're not planning on turning them into cash anytime soon. So that's why they're not short-term investments. Debt securities versus equity securities, and that's what we're going to be looking at in this chapter too, is the difference between the two, and that's the main crutch of this chapter outside the short-term versus long-term. You can have debt and you can have equity, both as short or long term. It really depends on management's what they're planning on doing with the investments. And that really is what's the real crutch of this. But our debt securities is basically anything that we buy that we're getting. We're not buying ownership. We're buying debt of another company, and they're going to pay us back, whether that's through installment notes, bonds, or CDs. Equity securities are things where you're buying shares of stock, and we are going to take ownership of some percentage of a company. So depending on what it is and how that works may depend on what we're going to do with it. So here's our classification reporting, and there's going to be another slide similar to this, except it's more linear. It's kind of just written out. That'll give you all this information and a little bit more. And I think it's instruments and equity investments, and each of them have different categories. It used to be that the insignificant influence of equity were just counted as either trading or held to mature, or trading or available for sale. But they have changed that now to where it's just debt instruments are those categories, and equity is just insignificant influence, which is fine. No big deal. But held to maturity is only a debt investment because there's nothing in as a stock that will mature. So held to maturity is always going to be debt, and it is always going to be management's intent to hold it until it matures. That's their intent. That doesn't mean that it's going to actually be what happens, but that's their intent. And then trading securities or debt securities that are actively traded by management, they're there and they're ready to they're trading it, they're selling them, they're actively managing it. That's the key you're going to want to look for trading. And then available for sale securities are simply securities that are debt that you can't classify as either held to maturity or trading. You're not actively managing. You're not actively managing it, but you're also not intending on holding it to maturity. Any of those are basically, hey, we got these other securities that are available for sale if anyone wants them. And that's what those ones are. Equity, you're going to either exude insignificant influence, significant influence, or controlling interest or in influence. Depending on the percentage of stock you own will be depending on what you classify those as. So let's go through each one of those. When we get a debt investment, we're going to record it at its cost, especially if it's a bond, okay? Debt instruments, we're going to debit $30,000 in this case because we bought it for $30,000, and then we're going to credit cash $30,000. When we get interest on it, we're going to just debit the cash we received in interest and credit the interest revenue. We're going to take the interest. In this case, it's semi-annually. So we're going to take the 30,000 times the annual percentage rate, which is 7%, and then multiply it by, you could take 6 divided by 12, or you could take 1/2 and multiply it by 0.5, whatever you want. But that's what you're going to do. And on the income statement, you're going to show interest revenue, and on the balance sheet, you're going to just show your debt investments for 30,000. So when they mature, we simply reverse the initial entry and receive the money back. Okay, that's your debt investment there. So let's account for debt securities as trading securities. These are ones we actively manage for profit. Remember, number 2, that's your key. If it says you bought debt that is actively managed by management for profit or something like that, you're going to know it's a trading security. It's always put in the current asset, and it's put and reported as fair value. Anything that is not included, anything that is change in the value of that, you're going to report it as an unrealized gain or loss on the income statement. All right. So if the value of that, let's say we had that $30,000 bond we bought, and it's a trading security, we're actively managing it. If that bond were to change value in some way, we would report it as an unrealized gain or loss and report it at fair value. So this is what we would do. We have trading securities that cost $11,500, a fair value of $13,000. The $1,500 difference is the cost of $11,000. Well, you see the difference. It's math. So you're going to record this fair value adjustment of trading and the credit to unrealized gain to your income statement. And then you're going to see here, that's your balance sheet there, that you're going to show the fair value adjustment to that. Now this is kind of where the crossover of how it used to be, because we used to have stocks in trading securities. I can't think of an example of when debt would become lower than fair market value of that debt. Unless maybe there's a different credit rating, Moody's or something changed the rating of it, and so it made it more risky, so it's not as valuable. I don't know. This made more sense when you had stock, because stock prices fluctuates on a common basis. But if this ever were to happen, this is how you'd report it on the income statement. And this is saying that the fair value increased somehow. See, again, I can't see how debt they either owe it to you or they don't, and so I can't see how this would increase. But I didn't do a whole lot dealing with the investments in my career, so it's possible that this is something that could happen. So if it does, this is what you're going to do. Trading, selling, trading securities. That makes absolutely no sense. How about selling trading securities? That might be a better way to say that. You're basically going to take whatever okay, in this case, we had securities at a cost of $100. We sold it for cash, 120 bucks. We're receiving the cash, debit 120, getting rid of the debit, the trading investments, $100, and then the difference is the gain. In this case, because we've got more cash than it was for what it was worth. If it was, say, we got like 70 bucks for it, it would be a debit to loss on sale for $30. So it just depends on what the circumstances are there. Accounting for debt securities as held to maturity. Let's go ahead and look at these. They're always going to be a current asset if their dates are within 1 year. Then otherwise, if their maturity dates are longer, it's going to be a long-term asset. But keep in mind too, there's always the current portion of debt that you can include on the current portion that you anticipate to receive in the long-term investments. And we're not going to have any fair value adjustment to the portfolio. We're going to hold it at amortized cost. So, sorry, hang on a second. Oh, these were held to maturity. Sorry. Yeah, we're going to amortize it. We're going to basically just report it as it is and get the investments. For some reason, my brain was thinking we were doing available for sale. This is available for sale. And these, again, are the same concept as the held to maturity. If it's shorter than the 12-month or operating cycle, we are going to have it as a short term. If it does not meet the short-term criteria, it'll be long-term. It's valued at fair value, but the unrealized gains and losses are reported in the equity section of the balance sheet in comprehensive income. It's a little different. It's kind of weird, but I'll show you that here in a second too. So if we have these available for sale securities, we bought Apple bonds and Intex notes. It looks like we had a fair value adjustments that caused the Apple bonds to decrease in value, but the Intex notes to increase. We're going to do a journal entry that's going to debit the fair value adjustment available for sale to reduce the value of those to show that what they're actually at. To increase it because the Apples were a reduction, but the Intex were an increase. We're going to show that we're going to debit the available for sale to increase that investment, and then we're going to annotate on the equity section of the unrealized gain of $15.50 on the balance sheet. And this is what our balance sheet's going to look at. Okay, we're going to show that the fair value adjustment and our total debt securities is $74,550. But then in the equity section, we're going to have unrealized gain on available for sale securities. It's going to be in there under accumulated other comprehensive income. And then in the next year, something happens. We have another gain. Looks like, let's just read it. Let's extend our example and assume that on December, the series has an $81,000 cost and an $82,000 fair value. Okay. So our balance at that time needs to see, this is similar. Oh wait, we haven't covered that yet. No, wait, that was in the 111. So yeah, we covered this in accounting 111 when we did the accounts receivable. I'm trying to remember what the method was called. The accounts receivable method, where we had to calculate what the ending balance needs to be. So we've already had these unrealized gains in the past, and we know that our fair market value is $82,000 of our current available for sale securities. So we need to know we need to have $1,000 balance. So we've got to adjust it to where we have only $1,000 balance. So we've got to debit our unrealized gain in equity by $550 and then decrease our fair value adjustments for available for sale securities by 550. Basically, we're making it to where we're kind of keeping a tabs and a tally of where we need to be at with these investments. So we may have sold some and bought new ones in this available for sale portfolio. And what's happened as a result is we have only $1,000 in our available for sale securities, and we got to reduce that adjustment so that it reflects accurately what we're at. All right, so that was all debt securities that we talked about. Now we're going to talk about equity securities with insignificant influence. Okay, it should be pretty straightforward. Anything under 20% is going to be insignificant influence. 20 to 50% is equity. It's going to be significant influence. Anything more than 50%, you can control that company. All right, and that's kind of what we call a hostile takeover too, is if you could buy enough stock to where you have 50% or more, you're basically buying into that company so you can take their equity or do something with that company that you want to do. A non-hostile takeover is where you offer to buy the company outright, and then the stockholders vote on that. So here we have an equity investment recorded at cost when acquired. Oh, wait. I thought it was an example. So ITI purchased 100 shares of Lynx for $7,000. Okay, if you're buying some small amount of shares in a company, more than likely it's insignificant influence, all right? Most of the time it's going to tell you what percentage of stocks or give you the total number of shares outstanding so that you can calculate what the percentage is. In this case, 100 shares, it's more than likely going to be the insignificant influence. Simply debit stock investments, $7,000, credit cash. Too easy. Then if you receive $10 in dividends, you're going to debit cash because you're receiving cash, and then you're recording dividend revenue. Okay, $10 credit. Too easy. We're recording these at fair market value. All right, so we're going to go ahead and change this and have unrealized gain. We're going to put that to our income statement again, just like we did the trading securities, which is consistent because this is exactly what it used to be classified as a trading security. Of course, it's not anymore, but point is we're still going to treat it as such, even though we've categorized it as something different. So if the fair value is $9,000 on December 31st, 2021, we're going to see a $2,000 increase in that value of stock. So we're going to have a fair value adjustment of $2,000, and we're going to have an unrealized gain of $2,000 as well. It's unrealized until we sell it, at which point then it's a realized gain, or just simply a gain. Here's our balance sheet treatment of that, and you can look at that, pause it, kind of read up on this, and just check that out. All right, so if we are selling our investments, we are going to then at that point realize any gain or loss in that transaction. So in this case, we're going to sell $800 for stock that had a cost of $500. So we're going to have a $300 gain on our investment. That's the idea when it comes to investments. Unlike treasury stock, when we were buying stock where we buy it back for high maybe and sell it low because we're giving stock options, this is one of those ones where we want to see a profit. We want to make money on this so that, the reason we had our money in the stock market at all was worth it. So here we're going to have this $300 gain. It's now a realized gain because we've experienced it based on a transaction. Okay, now we're going to account for equity securities with significant influence. We're not going to get too in the weeds with, we're going to talk about this at length, but I don't want to get too into the weeds with significant influence or controlling interest because there is a lot to do. Here's that slide again. Now we're between 20 and 50% stock ownership. And this is what's going to happen on many of the questions. You're going to buy 3,000 shares and it's going to say it's 30% of Star Company's common stock. At that point, we know we're going to put this under the equity method. So equity method investments is our debit, credit to cash for the amount we paid for it. When the company that you have a significant influence over posts their net income, you are going to realize a share of that income on your financial statements. You're going to debit your equity method investments, $6,000. That's going to go to your balance sheet, and then your earnings from equity method investments should be going to your income statement. Then if we received any cash dividends, we're going to go ahead and debit cash, credit equity method investments. This is like we're getting a return on our investment. They're giving us back our money for this investment. So we're going to decrease our equity method investments. So here's our equity method investment T account. We got the share of earnings, then we got the 3,000 of dividends. Basically, we're saying, hey, after all this is said and done, we have $3,000 worth of shares of $3,000 of our share of earnings still in the company, and we've gone back 3,000 of it in the form of a dividend. When we sell it, we're going to go ahead and debit cash of 80,000. In this case, we're selling it for 80,000. Our equity method investments, with that $3,000 of income that we had recorded on the prior slide, we're going to have $73,000 as our investment we got to get rid of. And then we're going to have or realize a gain on our sale of $7,000. Now, what happens when we have controlling influence? Again, I'm not going to get too much into this. It's very much in the weeds. The bottom line is we are going to consolidate the financial statements from the subsidiary into our financial statements. We are basically saying we have more of a parent and subsidiary relationship because we control that company. Wouldn't be any different than if we started another company and then had all the stock owned by the company we already had, at which point then we control what that other or what that subsidiary does, and we get to say, hey, if we want a dividend, we'll have a dividend. If we want them to do something, they're going to do it. So we get to. It's basically saying, hey, look, this is just like our company. We're going to put this all in our books. This is the slide I was talking about that might want to consider pulling this out. I would print this off and I would have this with me and I would study this slide. This slide is one that you're going to definitely use and it will be a helpful thing for you. So we talked a little bit about comprehensive income. All right, we're going to talk about this statement of comprehensive income. All right, simply can be just the lower half of your income statement to show all of these calculations, or it can be its own entire financial statements, up to whoever is making it. I don't know that there's any. I could be wrong on this. Okay, I'm just telling you that it's. I don't remember what the standard is on the statement of comprehensive income, but I'm pretty sure you can do either one. Bottom line is, though, you're going to take your net income, and then you're going to list out any other comprehensive income that you had, and you have here change in your value of available for sale investments, net of tax, change in foreign currency translation adjustments, and your change in cash flow hedges net of tax. Those are some examples, and I'm telling you right now, we're not doing any of those except for the value of available for sale investments. All right, because I'm just not going to put you through foreign currency translations or hedges. That is quite a fun time, but that's down the road. That's a 400 level class probably for you guys. All right, last thing we're going to do is we're going to look at the return on total assets. Our return on total assets is our net income divided by our average total assets, but it also equals our profit margin times our total asset turnover. So if you look here, if you're one of those math people, this is what something my chemistry teacher in high school tried to teach me, and I could never get it for the longest time. When you have two fractions that you're multiplying it against, if you have a numerator, sorry, that's the numerator, and a denominator that are the same, you can cancel those out and move these over top of each other. But here's the thing. You know this formula. If you don't have either one, if you don't have average, well, I guess that's not going to be a way to do it. Basically what we're trying to say is you can calculate this and use all those fancy algebraic stuff to come up with the answer here if you can. So like, let's say I only give you net sales and average total assets. Can you derive net income? You bet you can. Okay. Because as long as I give you like total return on assets or one of these other what it is, you should be able to calculate what it is. Just me kind of showing you that. Here's a slide on what it looks like here. So your total return on total assets is going to be your 8.4%. You're taking, this is Costco, mind you, 2.4 times 3.5, that gives you the 8.4. And we're looking at Walmart. You know, which company's on the range of doing better, right? Let's look at the trend here, 7.8, 8.1, 8.4. Costco's moving on up, okay? Costco's doing something right. the return on their total assets. Something there is working for them. And we can look and see that more than likely, because their asset or their total asset turnover hasn't really changed a whole lot, but we see the profit margins increased. So it looks like we're doing something good with the profit margin here. Whereas Walmart looking just stole on return on total assets, they're plummeting. Okay, their profit margin is probably, is my guess, is declining. But without this information, we really don't know why. So that's why it's good to see all of this information and be able to compare and calculate it. That's the end of chapter 15, guys. I hope you enjoyed that discussion on investments. If you have any questions, always let me know. Your word today for this chapter is Dwight. Dwight. Delta, Whiskey, India, Golf, Hotel, Tango. Dwight. Dwight. You guys have a good one. We'll see you in the other videos, and take care.